Hey everyone, welcome back to the Mike Rosehart Show. We're live again here for another episode, and thanks to a little thing called daylight savings, this week we have light. We have light. So we're doing on the back patio here. Nice little lake in the background. You can see there. Anyway, let's talk about this market. Down here in Florida, and today I opened my largest short position on companies like Nvidia, the Nasdaq, a number of other names and positions that I feel are overvalued. Now it could go higher. I've got stops, and I'm not fully naked or anything. I think it could continue to bubble higher, but we'll start with a few of the signals. One, we've had 3 inflation reports now that have been bad. What you should see, if rates are sufficiently restrictive, meaning rates are high enough, you should see pain in the consumer, you should see pain in the business sector, and you should see inflation going down. Inflation is growing. We're at a 4.8% annualized core inflation headline number. We had a 0.4 reading. 0.4 times 12 is 4.8% annualized. Now, with the Fed keeping rates at around 7%, I think the bond market is once again wrong. Everyone was pricing in rate cuts by 2023 late, 2024 early. We are not going to get rate cuts. We might get rate increases, potentially. Higher for longer is playing out in a big way, and it was, I think, in a lot of ways, unexpected. And I think the market is out to lunch. I mean, we're seeing all-time highs for almost every stock in the NASDAQ right now. We're seeing names like MicroStrategy at almost $1,800 a share, trading at double its underlying Bitcoin holdings. The company literally is a proxy for Bitcoin. All they do is buy Bitcoin and apply 20% leverage, and they're trading at 100% of their current Bitcoin price. Bitcoin's a risk asset. All risk assets right now are entering overvalued territory. Companies like Nvidia, last Friday we had $978 a share, almost $1,000 a share. It has what, 60 billion in revenue, and we're talking about it being worth 2.4 trillion. The multiple on sales revenue is insane. Is not quite dot-com bubble, but it's getting, I think in the current environment that we're in, it makes no sense. With hurdle rates needing to be as high as they are. The 10-2 yield curve has been inverted now for like 400 and something days. It is the longest inversion in history. It just broke the 1978 to 1980 yield curve inversion number of days, the longest period of inversion. There has never been a point in history that a recession didn't follow an inverted yield curve. So RSI, look at the everything's oversold, big time. Most stocks, the RSI number is so high, it's very rare we go to these levels of oversold territory, overbought territory. I meant to say overbought. Where people are just lining up with their wallets and their checkbooks. You go on the forums right now on Yahoo Finance or Google Finance or any of the Reddit forums, and you look up like in the Nvidia forum or the Bitcoin, or pick any garbage risk asset. And like, I actually like Bitcoin, so I'm long Bitcoin. I hold Bitcoin, but in that space, there's a lot of degenerate risk assets and risk plays. All of that, the dumb money is chasing at a rate right now that like no stops, no risk protection, all in leverage. And that's, a little bit dangerous. And the only thing that stopped us from having a recession is that the Fed has been printing money and continuing to run a huge deficit. And that printing of money and devaluing of the currency has been the only thing that saved the economy on paper, making it look like we have, at least in the US, great growth. And I mean, AI in large has driven a nice little bubble. Though I think AI will lead to productivity increases, there's definitely a lot of risk ahead, a lot of turbulence. In the frothiest of bull markets, we should see a 10% correction before going higher. We're purely in, I read a good article the other day about, I try to inform myself on things that are counter to my current way of thinking. Like, I'm long Bitcoin, I'm bullish Bitcoin. So I read as many articles as I can that tell me that Bitcoin's not great or why it's not going to go down. And it's interesting, like one of the, every time there's a bull run, if you look at all the bull run cycles of Bitcoin, and we're in a frothy bull run cycle, and I have no idea where the top is going to be. It may be a little while longer before we top out, coming up into the halving. Typically, the halving is actually a sell the news type thing where Bitcoin actually goes down initially, but anyway, it rallies into it. And in every other cycle, there's been something special about Bitcoin. It's like, we're talking about how it's going to transform this or do that, or some narrative where there's value behind it. And this time it's like there's an ETF and there's momentum flow. And it's like all people are talking about is like, but someone's going to buy it for more later because inflow. And it's like your whole justification for buying is someone else is going to buy it for more from you. That's greater fool. So the driver right now on some of these risk assets is just like, we're going to cash it out later for more. Completely greed fed. The entire market right now is at an 81 out of 100 on the greed index. And it's been that way since last time it read a fear reading was October 26th. It had a fear reading of 21 out of 100. That was a great buying opportunity. Whenever there's fear in the market, good time to buy. But it's been greedy now, November, December, January, February, March. We had 5 months of blow off the top greed and hopium and just pure, I guess, blind ignorance to anything to do with fundamentals or balance sheets. Things are trading. I mean, NVIDIA had some good earnings. Don't get me wrong. Some of these companies are having record earnings, and that's because inflation's running wild in real life, right? It's really interesting. I think that the lesson here isn't to short, right? I'm not trying to get at the idea that you should short, because I think that's a dangerous game, and the market will stay irrational longer than you can stay liquid. And I've tested that myself and lost millions, proving that point to myself. Even though I already knew the point, but I had to learn the lesson the hard way for some reason. It's like, hey, you can't walk through that wall. I'm like, I'm going to try anyway. But the lesson here is that you should have hedges on right now. And let's talk back to real estate and the overall economy and where I think things are going. Inflation is running high, which is generally good for earnings for companies because they can pass that new pricing power on. The problem is that when you run inflation the way we have for the last 3 years, and groceries are up about, this is anecdotally, but data supported in certain local markets 40 and 50% for groceries. Now, that's wild. Housing, 40 and 50% over 3 years. We're talking about rents and I'm talking about my local market, I'm talking about Florida. In the markets that I study, rents are up 40 and 50% over 3 years. Housing prices still, since 2020, is up like over 100%, meaning it doubled in like a 3-year period. And not only did it double, but then interest rates went from 1% to like 7%. And so your cost of interest on that $1 million house was $10,000 a year in interest and is now $70,000 a year in interest. Or it was $50,000 a year and now it's $350,000 a year just in interest costs to carry that property. Now, if you're a landlord, that means you have to raise your rents, or you have to find a way to generate, where else can you cut costs? You can't. Utilities are skyrocketing. Everything is increasing in price at a rate that's not sustainable. What we actually need now is deflation. But deflation destroys everything. So they will not let deflation happen. The government is running large deficits. Deflation's not an option. So really, the only option we have is to raise, effectively, is to raise wages, right? Like wages have to spiral up. You can't pay people 50 grand a year and expect that now that 50 grand only goes half as far as it did 4 years ago and expect people to live and to be okay. So you've got to actually bring in the only real saving grace, I think, in the next 10 years for this inflation problem that we have is computing power and AI, and the future of technology can deliver increased productivity in ways that I think, it really ensures that we get a lot more productivity out of the inputs that we have. Hopefully, that wealth is transferred to the bottom 3/4 that are suffering right now. Because the rich are richer than they've ever been. The Elon Musks, the Jeff Bezos, the Mark Zuckerberg, all of the wealthy, even the top 1% who own assets. If you bought a property for $700,000 or $1 million, and over the next 10 years we have inflation at running 4 or 5% compounded, which is double. That's 100% more inflation than they want. They want to target 1.8 to 2%. And it's been running at, since 2021, inflation's running at like 7%. So let's say we have another couple years where it's 3% or 2%. Our average over the 10 years is still going to be really high. We went through a massive amount of inflation. And even that headline inflation number isn't even all that accurate. In the real world, the price of things has been ballooning in a way that isn't captured accurately in the way that they currently break down their basket of goods in their CPI reading. So it's a CP lie. Real inflation is much higher, and they manipulate that number to make it look better than it is. And even with that manipulation, we still have double the inflation we should. 4.8% is more than 100% higher than the current rate of inflation run rate we should have. we should have under 2%, which means we should be having readings of 0.1 to 0.2. And in fact, because we have these readings so high since 2021, when they said it was transitory, and then in 2022, when they said, okay, maybe it's not transitory, but we're going to get it under control, and then 2023, it's like, it's still massive inflation. Now we're like getting into like a third of the way or a quarter of the way through 2024, and we're seeing inflation accelerating, but at a rate where we have interest rates at 7 and 8% to borrow against business projects and to fund your real estate projects, et cetera, so forth. With rates this high, it should be restrictive. Policy might not be restrictive enough. We should see inflation trending down every month, even with seasonal adjustments, and it's not. Meaning we may need to go higher with interest rates to push inflation down to 2%. What should happen when interest rates have to be, to bring inflation down, interest rates, I mean, the way that the Fed is going to do it, there are other ways actually to bring inflation down on the supply side. There are other things they can do, but they're playing with one lever, which is like interest rates, and how much money they print, unfortunately, as well as a lever that the Fed has no control over. Technically, the Bank of Canada, the Federal Reserve, doesn't really control how much Biden runs up a deficit and effectively prints debt to other countries. That also creates inflation, but if every country does it together, then it's more of a complicated mixed bag, right? So there's a multitude of things coming together to help understand the whole picture, but there's a lot of risk right now. And I don't want to say we're in a bubble, but like it feels a lot like Tesla. NVIDIA feels a lot like Tesla did in 2021, 2022, when Tesla's fallen 60% from its high. 60% of its value gone. I think NVIDIA will follow a similar path. Tesla was the golden child. It was growing like crazy. It was profitable. It was NVIDIA, right? If you go back 2 years ago, like the energy and the sentiment feels very much the same. Someone will come in and eat their lunch, just like people are coming in to eat Tesla's lunch. There are going to be competitors who get into the space and do a better job. It takes them, they'll have a first mover advantage. NVIDIA has the first mover advantage, but the margins will squeeze. They'll go from 60% margin probably to 30% or whatever. Competitors will get in the space, and it will drive, challenges and a wedge, I think. There will be a time to short NVIDIA. It's probably not now. I'm probably early. I'm usually early on all my forecasts. So I think the pain may not come till election time. I don't know. They could prop things up until this fall. I say they, I mean, the Biden administration wanting to look good, right? I don't know. I'm trying to get political with this, but everything's fucking political. I mean, it's the nature of the world, and it's just how it is. Look at that beautiful lake behind us there. You can see that. Yeah, I forgot my train of thought now. Talking about recessions and what you can do about it. So let's talk about some things you can do about the current potential recession coming up. And what's interesting is like everyone knows the recession's coming. And so in a lot of ways, that actually saves the market from crashing because everyone keeps hedging. And that's what you should do is the first point I was going to make is hedge. If you have stocks right now, if you hold the index, you can buy puts or you can sell calls, or there are ETFs you can use. You can just buy the ETF that are already hedged for you, which means they're protected against downside. So for every 1% the market falls, you lose 1/4% instead of 1% because you're hedged. And as a result of that, you give up some of the upside too. So if the market goes up another 10% from here, you may only make 3% or 4% instead of the full 10. It takes your volatility and it squeezes it and makes it safer. Really important in times like this where we have the NASDAQ up 60% off the lows, 65% in just over a year. That's an insane amount of growth in a short amount of time. And if we were in a bull market where we were at 2%, under 2% inflation and rates were still 2%, I'd probably join in the party, to be honest. To blow off the top market, I would go long in the market, buy the indexes, and I'd probably just hedge a little bit. But there's so much geopolitical danger right now, so much danger in so many different places right now. It's like there are so many landmines and catalysts for downside, and the problem is too with the way we've set things up, the fall is so fucking fast. What you get is like a Black Monday type of minus 8% on the index when shit hits the fan. We've moved up so fast, it'll move down so fast too. So that's a danger or a risk, I suppose. Let's talk about real estate too, because I've been really bullish about real estate this spring, and seasonally, we're gonna have a great spring. But it is not good for real estate. All the stuff I just talked about isn't good for small business, and it isn't good for real estate. If rates go higher for longer, it squeezes all of the commercial real estate that is currently hanging on by its friggin' last straw. And a lot of these products are renewing in 2024 and 2025. If rates are still high in 2025, I foresee a commercial real estate minus 10% correction, minus 15% correction. Or what's worse is inflation runs at 6-7% and real estate doesn't keep up. That's a real possibility. Also possible, real estate goes up 5%. We look great on paper, but inflation's 5%. So you actually made nothing, which is what's been happening the last year in terms of real estate. Actually, in Ontario, we've lost to inflation. Spring of last year to right now, I think the real estate market has fallen over 10% in our local market. And inflation is like in Canada or in Ontario is like 6%. So it's a 16% loss to inflation in real returns in terms of real estate. Now, over the long term, supply and demand imbalances that exist currently in Canada should be bullish for real estate. So there are a lot of bullish pressures trying to lift the real estate market up. But at the same time, there's some real headwinds. Like rates being this high is, I think, sufficiently restrictive for real estate developers, real estate builders. Construction is grinded to a halt. I know a lot of guys who are laid off right now. I know a lot of pain exists in the real estate space. And, they're not building. And we have so many new people coming into Canada. And so on a supply-demand chart, the imbalance is getting wild. So that mixed with the fact that like in terms of inflation, these trades they want more per hour than they ever have. Minimum wage is like almost $17 an hour in Ontario. I think it's almost $17 an hour, which is crazy, 16 something an hour, which is wild, right? It's crazy to me that and the fact that wages need to go higher, to be honest, for people to survive the way things have inflated. And the problem is there is no deflation. It just doesn't happen. Prices don't fall. They just chug along up. The market they'll drop rates if prices start to fall. They'll never let us have any retracement back to where prices were before on the aggregate or on the average, right? Just is the way it is. Okay, let's do some Q&A. Jumbo says, Bitcoin's flying high. So true. Corinne says, hey, Mike, hope you're doing well. Is it easy to get a permit to build a separate entrance for a second unit with the City of London? No, City of London is mad hard to get permits with. You need drawings, you need to work with. I go see a BCIN. Someone has a BCIN stamp, or you can see an engineer too. But a draftsman that has a BCIN stamp will do drawings for you. Then you get the contractor to do the work. Doing things with inspections takes time, it takes money. Is it doable? Yeah, totally. But there is definitely cost associated with doing it. It's why probably 2/3 of the real estate investors that I know, growing up and seeing all these guys do this stuff, they're all cowboys. None of them got permits. They go in there, do floors, paint, renovate, fix houses up. Most of the flippers weren't even getting permits. So that's because London was so difficult to work with. It took so long to coordinate inspections. They were anal about the stupidest shit. They would miss the big stuff. I can't tell you how many times I've been through a new build and the City of London building inspectors missed massive structural shit. Like they're arguing with you over like a mixing valve on a hot water tank. And it's like, come on. Like, or on a tankless once it's like the tankless, you can set the temperature. It's like, what do you need a mixing valve for? To set the temperature so no one burns himself. You just adjust it on the tank. Stupid stuff, like stupid things that they're fixated on and then missing the big stuff sometimes. I don't know. It's any municipality. They have a lot of red tape, a lot of challenges associated with that. They're understaffed. I mean, they're going through their own challenges in and of itself. It's doable, totally doable to answer your question, but not without cost and delay. If it's your own house, you don't care if it takes a couple months, you're all good. Probably a good idea. If you're inexperienced in construction, getting a building permit is super important because the contractors could fuck you around and they could not do the work properly. And building inspectors are supposed to make sure that the work's done properly. And so any good contractor, they'll mark your project up. So they'll add a couple thousand to your budget of your quote to do the work because they have to deal with the city. But then at least things are done properly, which is good. David says, how you doing? Hey, how you doing? Joseph says, hey, Michael Ball's doing well. Do you think it's possible to retire on $1 million in today's economy? If so, what would be your own investment strategies to make it last? So I think that in this market right now, you can get a 10% risk-free return. And I mean risk-free. I mean, you can go lend against a property 60% loan to value, super, super safe, and guarantee that you'll have no issue. I think it's one of those things where, so let's say $1 million, and we'll follow that line. You get 10% risk-free right now, which again, like your HELOCs are at like 7 or 8, so not that much above what the bank's charging for cheap home equity line of credit type debt. But 10% risk-free on $1 million is $100,000 a year. So then the question becomes, if you can produce $100,000 a year in passive income for no work, and you can call any mortgage, you can call like 10 mortgage brokers in Ontario, and I guarantee you a bunch of them right now can get you 10% risk free. Set the parameters at I want 2 appraisals, or I want an appraisal plus a CMA from a realtor, get a second opinion from a realtor because you're lending against an asset that's a house, or a building. And you want to make sure the underlying building is super solid and the value is there. If they stop paying you, is there enough equity there to cover things? So that's super important. So do your due diligence, making sure it is actually risk-free. But if you're lending at 60% loan to value in this market where real estate's already taken a 30% haircut in terms of price from the peak, you're pretty protected. And in a first secure position at 60% loan to value, you don't really have to worry. So I would consider a risk-free return. The government would step in before you would probably lose $1. And so 10%, you could probably get 12% right now. I actually think you could. If you put a little bit of effort, a little bit of energy in, your $1 million could produce you $10,000 a month, so 120 grand a year. And you want to reinvest some of that to beat inflation. So inflation's say 5% right now, so you need to reinvest $50,000 back into the portfolio to beat off inflation. So inflation should come down. It has to come down. And in the process of it coming down, we should go through a recession, but it will come down. And when it comes down, you should expect to put 2% back into your portfolio. So it will eventually put $20,000 a year back into your portfolio as you're beating inflation adjustment to your portfolio, because you want this portfolio to produce income forever. So in year 2, it's going to be 10% of $1,050,000 or 12% of $1,050,000. So in year 2, you're going to make $10,500 a month in passive income because you have to adjust for inflation. You need to be increasing your passive income each year. And you don't ever deplete your original portfolio. So it's important to do that. But I guess the question is, could you live on 100 grand a year? And I think that's pretty easy considering the majority of Canadians live on less than 60 grand a year after tax. So families, a single individual lives on average like 40 grand a year. So you're making 2.5 times what the average Canadian spends in terms of like raw spending. Now, if you could figure a situation out where you're house hacking with roommates, where you got a duplex, or you use some creative rent hacking or house hacking strategies, you can get that number way down. You could live on like 500 grand invested, produces like $50,000 a year. Let's say you took out 2,500 a month and left the rest in your investment portfolio to grow over time. So you're taking about half of what you're earning. I mean, you're bringing in more than enough to retire early. So in terms of like, is it possible, Joseph? 100%. Like it's no brainer, easy. In fact, like, why keep working after $1 million? Why keep working where I'm at even? I ask myself all the time, like, what am I doing? It's like, why do I keep pushing myself? And maybe that's, in part why I got into options trading and buying all these buildings is like just something to do, a challenge, a struggle. But it's like humans, we love struggle. We love challenge. We don't need that. My challenge could be, building a guest house or something, I could find something else to do with my time that isn't as stressful, I suppose. And then the second question was, what would be your own investment strategy to make it last? So Joseph, I like diversity. So for me, if I had $1 million and I had to diversify the portfolio and I had to retire on it, I'd probably take like $50,000 of that and put it in crypto. Not now. I'd wait for the next crypto bear market, or I would slowly dollar cost average into the market. You don't go all into the S&P 500 at all-time highs. You might put a couple of percentage points of your portfolio in. So if you had $1 million, probably what I'd do, given just right now where I think assets are at, I think everything's overvalued in terms of like the stock market. But if I had to put things in a index, I would pick like an emerging markets index. Like Russia's been cut off. So investing in like somehow getting exposure to emerging market, like the Chinese stock market is destroyed right now. A lot of the South American countries are just pummeled right now. So there's real value in some of these companies. So buying the entire indexes of those nations would, I think, be a good use of 10% of your portfolio. So take 10% of the million, take 100 grand and put it in a bunch of those companies. They'll pay some dividends, whatever, that'll be your capital appreciation. And then I'd probably take the other 900 grand right now. Okay, I could see the argument for taking some of it and buying a house. Go buying a duplex, a nice duplex that's got a 3-bedroom and a 2-bedroom. Go live in the 2-bedroom, rent the 3-bedroom out to cover the mortgage and live for free. Maybe buy a triplex, do the same thing. Maybe buy a duplex with a guest house in the back. Maybe you live in the guest house in the back and the duplex you rent out, it covers all your expenses because interest rates are so high right now. You might need 2 units to cover your expenses. You live in the guest house for free. Now your living costs are way down. So you only need like probably to withdraw $1,500, $2,000 a month max to cover your living expenses because your housing is more than half of the average person's burn rate, right? Of what they spend in a month. So that's a smart way to do it right there, I would say. And then in terms of like what would your down payment be? So let's say it's a $500,000 house. You probably have to put 100 grand down. So there's 100 grand gone. So you 100 grand, you're diversified, emerging markets. Maybe by the Russell, some of that equity portfolio could be the Russell 2000, the IWM. The Russell index is not up very much. I think it's up 6% on the 1 year. Small businesses, it's a collection of 2,000 companies in the United States that are not large cap. They're mostly small cap stuff. So those businesses are suffering right now. And they'll have the most growth, I think, when things recover. So in the recovery period, when tech takes a dive, I think there'll be a resurgence into dividend stocks, because dividend stocks are pounded right now too. Dividend stocks or utility stocks, they've had a little rally recently, but like dividend stocks in general got really beat up because when you can go invest risk-free with the Fed at 6%, it's hard to want to buy a dividend stock at 6% dividend when there's competition from risk-free bonds at 6, 7, 8%. You can go lend against real estate at 10%, nearly risk-free. So there's that challenge, I think, in a lot of ways right now with those stocks. So as yields fall, eventually what you'll see is that the bonds, like the TLT could be a good place to put some money. It's an ETF that tracks the 20-year treasury. And as yields fall, then that would do really well. I think yields will eventually fall in the next 2 years. Typically, that's not good for stocks, actually, when that process we're going to go through, where we go from high rates to low rates, is usually as we go through a recession. It's usually when they finally break the businesses and the people, and they break everyone. By breaking everyone, they break inflation, bring it down, and then they can cut. And the cut can only come from the pain, usually. So I'm yet to see the pain that's going to cause the cuts. But then I probably take the rest of it right now, and I just put it in like debt, like real estate investments in terms of like mortgages. As opposed to equity, I think that debt makes more sense. So you lend on a house at 10 or 12% or a building, go find a 20-unit building in any market that you're in and lend on a 60% loan to value. So the owner puts up 40% of the purchase price and you put up 60%. Or they already own the building, you get an appraisal and you lend a small percentage of what the building's worth. That way, if they don't pay you or if something happens, you can take the building and you make a huge profit. So the best case scenario is you want them to default. Whenever I try to do a loan, I want them to default. I think through what happens if they don't pay me anything and they fuck off and they die. I have to take the building. That's what I want. That's the best case scenario because you bake in tons of fees. Your yield goes from 10% to 20% or 30%. You take the building back at a huge discount. On a $3 million building, I might lend $1.8 million, which means if the market goes to shit and the worst case happens, the building's still worth $2.5 million. Let's worth 3, now it's worth 2.5 or 2.2. I lent 1.8, so I'll never lose $1. That's the important thing. You don't want to ever lose. Risk prevention, so important. Risk management and not losing money is the most important rule in terms of lending. Is like evaluating risk, and the lower the risk, the higher the yield, the better. And you want to find that arbitrage between really low risk and really high yield. Usually, there's a lot of risk with a lot of yield. Like you're buying Bitcoin right now. Bitcoin may hit 30,000 a token in the next 3 years. Like I flip a coin on whether Bitcoin hits 200,000 or 30,000. No one has a fucking idea. The truth is, there's a lot of volatility. This day today, 4 years ago, Bitcoin lost 50% of its entire value in 1 day. That's going from, imagine today, if it went from 100,000 Canadian a token, it's like 97,000 Canadian a token, down to 40-something thousand a token in 1 day. That can happen. There's a lot of leverage and a lot of risk associated with that asset, and the intrinsic value is in the eye of the beholder, right? In terms of it, I guess there is a rock bottom price in terms of computing node value and the value of the network itself, but I mean, it's really easy for a competitor to come in. They have a first mover advantage, but there's a lot of risk there. Just as an example, I like Bitcoin. I don't want to beat up on Bitcoin because though I think it's run up a little too fast, too soon, I am still bullish. I am a holder of Bitcoin. Full disclosure, I have Bitcoin. So, it's like, I don't want to rag on Bitcoin, but pick any other risk asset right now. It's just like a lot of risk, a lot of overvaluation out there. And we're overdue, well overdue for some sort of correction here. So, Don, thanks for the comment. Appreciate you. Next question was from MMA Keyboard Warrior. It says, hey, Mike, I have $10,000 to invest. What do you recommend I do with it? I'm from Toronto. So, I mean, you're not going to be able to buy any real estate in Toronto. That's for sure. There shouldn't be a T at the end of Toronto. But I don't know. Normally, I would say spread it out in like a few fringe assets and let it grow. Normally, I would say buy the index, dollar cost average in, and don't look at it. DCA in. We're just at all-time highs. We continue to set all-time high records. And so that poses a challenge, I think, with a lot of risk. If you're going to buy into the market, Here's probably what I would do with that 10 grand if you didn't want to lose it. I would say it's important to take that 10 grand, buy into the market, but hedge against your downside. So buy some puts or sell some calls on that underlying asset to make sure that you're hedged against downside. Now, if you don't understand options, you don't understand how to do that, there are ETFs you can buy that have hedges built in. So if the market, we go into a recession, you don't lose your 10 grand. Instead of your 10 grand going to 5 grand, if the market collapses, your 10 grand might go to like 9,500. Then you can live to fight another day. You can use that money to buy the dip on the bottom. That's what you want to do, is buy the dips when there's massive fear. The opposite of what we're going through right now, which is massive greed cycle. It's a blow off the top cycle type of market, and it feels like there's just so much momentum and energy for things to go higher that it may go higher. The thing is, in that type of market, there's no underlying fundamental. So when the momentum shifts from bullish to bearish, it falls so fucking hard and so fast. There's a lot of risk right now buying at the all-time high. Now, 10 years from now, we're gonna look back and probably the price of this S&P 500 and the NASDAQ, unless we're in a major recession 10 years from now, is probably higher than it is now. So there's upside. But imagine if you had to hold the NASDAQ for the next 5 years to make back to where we are now. That's happened before. Last time people bought in, it took several years to come back to an all-time high, right? So it's like you may have several years of no return. Whereas contrasted or compared to, debt investments right now, where you can invest in different types of bond products and mortgage products and get a 10 or 12% risk-free for the next 4 years. If you compound that, that's like a 60% return by investing in debt with no risk. Whereas I look at the equities market and I'm like, I can get almost equity level type returns in the debt market with no risk. So it's a unique time in history where I think debt actually is a better investment right now than equities. So personally, that's where I'd put money is in debt structured type products. So, you could take $10,000. You can't really do a mortgage product, but you could join a syndication. There are lots of syndicated mortgage products that pay 10, 12% that you could join into. Inside your tax-free savings account, there is no tax consequence of lending and collecting interest income. Now, let's talk about tax for a second here. I'm hoping to get away from tax. I have such losses that tax hasn't been a consideration recently because I've made such a bad job with my options trading business. But, passive income in terms of interest income is taxed at 54% in Canada. Whereas capital gains, if you buy a stock and you sell it, or you buy a property and you sell that property 2 years from now, you have a capital gain, you're half tax-free. Half is taxed. So your max effective tax bracket is like 26%, because if it's 54%, divide it in 2, right? Or 52% divided in 2 is 26. 26 and a half, I think it is your max capital gain. So from a tax perspective, capital gains are a better way to earn income. But inside your RRSP and your tax-free savings accounts, you should be always having debt type investments, because the tax savings of being in a tax-free vehicle and earning interest income saves you 50% more in tax than you would have from a capital gain. So a lot of people, I think it's silly, but they buy equities inside their tax-free savings account. And the better thing to do is to go set up your tax-free savings account with something like Olympia Trust or a third-party mortgage trust that can go and lend your TFSA out against real estate in terms of a mortgage. A lot of people don't know you can do that, but you can take your tax-free savings account, you can lend it to your friend Kyle against his house, and he can pay you interest into your tax-free savings account at great rates. And sometimes even 15, 20% yields are possible. And that's all tax-free. So the tax-free savings account, a great vehicle for that. Definitely big fan of that. So in terms of investing, again, just to keep going down that line of thought and just flesh that out entirely, if I knew you and we were doing a coaching call together and you were telling me that you had a marketing business and you're like, hey, when I invest $1,000 into marketing, it generates me $3,000 in new business. And my margin is 50% profit. So on that $1,000 investment, I make $1,500 profit back. That's a 50% ROI. In those situations, I would tell you, go invest in your business. If you have a skill set, like you sell something on Facebook Marketplace, you flip couches or something, or you have a Amazon FBA business, or you do some sort of consulting or marketing, or one of those agencies that helps people with their social media, or one of those businesses. All of those businesses, if you're good at that, investing in your business is the best place to invest your money, especially if you have 10 grand. You don't need to worry about diversifying when you have 10 grand. The return difference, if I tell you the best index to invest in and you make a 12% yield, on average the market returns 9%, 8-9%. So if I get you to beat the market by 50%, that'd be a 12% compounded return versus, 8%. So if you beat the market by 50% on your 10 grand, we're talking about like a difference of like a couple $100 a year, like $50 a month. Is that going to change your life in any way? But that $10,000 invested in you and your skills and your business could yield you 1,000% return over the next 2 years. So it might make more sense to, there you go. So you say you actually do marketing for clubs on Meta. There you go. So investing that $10,000, if you can generate, like do a beta test, take like $200 and run some ads. And if you can prove that spending $100 or $200, that you could generate double that money back in revenue or triple that money in profit back from that investment, then I would scale in more of your asset pool into that stream into your business, because in your business it's going to generate the highest yield. It's like for myself, and I mistaken, like if I was consulting with myself and I was a coach for myself, like what the fuck are you doing with Interactive Brokers trading options? Like, Mike, you're a god in real estate. You double shit every 3 years in real estate, almost guaranteed. Why have you not put your entire net worth into real estate where you have full control? And it's like, well, the counter argument for that is like, I like some diversity. It's like, okay, fine. You can have some money in the index, some money in cryptos and other asset classes, fine. But like, where else can I deliver alpha? And alpha is like an edge. Where else do I have an edge to beat the market? Because I don't have a way to beat the market. I can't predict better than the best quantitative computers. I can't predict where prices are going to go. And the best economists in the world, I can't predict with any reliability. No one can, really. Even the best PhDs, the guys who spend 80 hours a week trading, for the most part, over a 25-year, 50-year horizon, Warren Buffett said it best, they don't beat the indexes. But in real estate and in business, you can beat the index. Most business owners that are successful that I know, they crush the index returns. They put $1 million in their business, that spits out $3 million back. There is no index you can buy. The S&P 500 is never going to take your $1 million and spit back $3 million, except for maybe right now, the little bit of leverage in this crazy greed market we just went through. But that's hindsight. I don't think it's going to do what it just did again. Like, I don't think the Nasdaq's going to shoot another 55% up after it just shot up 65%. It might. I mean, things get frothy. People get crazy. They get FOMO, fear of missing out, and they jump in. And those are the bag holders. They're the idiots who buy at the top, and they end up losing the most. Those people will pile in because they want to taste. The hardest part of being a good investor, I think, is resisting your emotion. In real estate, in business, is your brain tells you incorrectly what to do almost all of the time. And if you calm down and you don't let emotion guide your decision, and you take a beat, take a minute, wait a day or two, think on every decision, you'll often find that you'll make the right decision when it's calculated and you don't make an impulse buy. Your buddies are all buying Bitcoin, so you jump in and buy Bitcoin at $100,000 a token. Is it the wisest decision? I don't know. When no one's talking about Bitcoin, 1 year ago when it was 28,000, 25,000 a token, and it was no one gave a shit about Bitcoin. I mean, Michael Saylor was still screaming from the mountaintops that he loved Bitcoin, but like, not the bulls. When the regular people weren't talking about it, when everyone was like, I've lost 50% on my Bitcoin portfolio, that's actually the time to be the investor in Bitcoin and dollar cost average in. Now it's like, might buy a little bit, but don't go balls in as things are frothing when the chart looks like this. I don't know where the top is. Don't try to guess the top. Don't short this by any means, because it's hard to guess the top. Don't be me. I was stupid. I tried to short the Nasdaq, tried to short Nvidia. I tried to short a lot of names and I regret it. And it's like, I was right. Like, Nvidia will probably top out at 1,200, 1,400, whatever, but it will also hit 600 again in the next 3 years with very high likelihood. That's just how this shit works. Goes way up, gets overvalued, then overcorrects. And what I've noticed is more now than ever with technology and the rampant spread of information, the cycles are going faster. So it used to take years for things to play out. Now it plays out a lot quicker, a lot faster. What I'm noticing is that the falls are more exaggerated and the peaks are more exaggerated. So we're having more wider volatility. So where things would have spiked 50% and then fall 50%, now they're going to spike 200% and fall like fucking to zero. That's what we've been seeing. A lot of craziness. Another person says, hi Mike, how are you and the family doing? We're doing good. Overall, we're doing okay. We're down here in Florida. It's beautiful. We're working hard, getting lots of things done, being productive, spending time together. I can't complain overall. Really excited for the summer. I'd like to optimize some things in my life that, from a time perspective right now, I think that I could make some key hires right now that would change my life dramatically. So finding the right people to help change my life and buy my time back are my current priorities in terms of like my personal goals. I have lots of money. I don't have lots of time. And I'm realizing more now than ever that my time is precious and I've been wasting it. And it's become very acute issue the last few weeks where I've noticed that I need to spend more time with family and on things that are not just monetary pursuits. Thank you for asking, Gail, on a personal level. Mr. Frugal says, any tips on making the seller realtor on board with my lower fees as a prospective buyer? I feel like my offers are mostly getting blocked by the realtor and not the seller themselves. Okay, so getting them on board with your lower offers. So in terms of like, you could bribe the agent. One way to get that done, I found, is let the agent double end it. So you go to the listing agent and you double end it with them. Say, hey, I'll give you the buyer's side commission if you push this deal through. And they will. They'll convince their sellers to take way below market because they want to get paid twice. They get paid on the buyer's side and the seller's side. So realtors are mostly greedy and selfish, so you got to appeal to the realtor. How can they get paid better? They're also lazy, so if you can make it really easy for them with a nice, clean cash offer, that would probably get them to want to convince their seller to just sell. So how do you convince the realtor to do that? Well, in a dead market, that means making it really easy for them, which means, again, a firm offer, cash offer, don't waste their time, and then pay them more money. And you can pay a realtor more money too. Like you could say, hey, how could you incentivize them legally? You could say, hey, I want you to rent this house out for me after I buy it. And I'll put it in a contract. I'll pay you 3 months of the tenant's rent. It's like you could pay them a crazy amount, like a $10,000 fee to rent this place out after. That's legal. And then they're getting a huge incentive to want to put the deal together to make 10 grand. So there's a 10 grand extra on top of the double commission you're going to give them. Oh. Okay, next question. How high is Bitcoin going? I have no idea. I mean, at some point we're going to see Bitcoin hit 250,000 a token. Will it be this cycle or the next one? I don't know. Inflation is going to drive Bitcoin to new heights. Bitcoin also, though, may hit 30,000 in the next 2 years. So if you can sleep at night knowing you've invested $1 million in Bitcoin and it goes to 300 grand, are you cool with that? Can you lose $700,000 on paper right now and hold through this next cycle? And if that answer is yes, sure, go on in. If you might need that money to buy a house in 2 years from now, or for some other investment you want to take on or whatever, you need that money out, and you need access to it, don't put it in Bitcoin because there's a lot of volatility. And so in high volatility assets, and you need access to that money, you're fucked. So that's a downside, I guess, is illiquidity of high volatile assets. I don't know where the top is, to be honest. I think it'll push to 100,000 this cycle, but I don't know. I do not know. Just guessing, just speculating. Tomorrow we could have a World War III and Bitcoin could go to 20,000 a token. Tomorrow the government could come out and say, hey, we have come out with a new central digital bank currency and fuck Bitcoin. We've made the off-ramps legal and now it's dead. You don't know, right? Like any shit can happen. They're fringe situations, but if the government wanted to, they could shut Bitcoin down tomorrow. I don't think they will. I'm a holder of Bitcoin, but again, it's not a large percentage of my net worth. Andrew says, hey man, any recommendation on a good M broker to help with private lending? M broker meaning mortgage broker. Yeah, I've got a few I could send your way. I also do private lending, so happy to help if I can. I have RSP money just sitting there because of the paralysis. I've not taken any action. So you should take action. It's a good idea to take action. Here it says, hey, for residential, are high ratio mortgages good or bad? Bad for the most part. Residential CMHC high ratio mortgages come with a 4% fee on your 5% down payment, which means you lose all of your down payment immediately the day you close. You go refinance the property later, you go sell the property later, your equity's gone. So I am not a fan of CMHC for someone getting into the market unless they have no other option on the residential side. On the commercial side, it makes sense. On the residential side, it doesn't. On a duplex, triplex, single family, it doesn't make sense to do the 5% down. The fees associated with it are too high. It's cheaper to go borrow the money at 15% from someone than it is to go with CMHC. So that's my thought. Especially when rates were low, CMHC made no sense because the fee was 4%. They were lending at 1%, 1.5% back then. So you're paying 4 years of interest upfront as compounded fee added to your mortgage. It was insane. They were just like cleaning up on people. I don't know how all these real estate investors could promote it when the math doesn't support it. Cody says, I have a single family home that has 200,000 equity and cash flows at $1,000 a month after mortgage and bills, insurance with 2.5 interest rate for 5 more years. Would you sell or private lend that 200? I mean, the question is how much of that can you access right now? Could you put a second mortgage on it? Could you access some of that capital out without adjusting the current low rate mortgage? Because it's got a really low rate mortgage on it. I would see that out. I'd ride that through. If I had a 2% mortgage, I would just probably keep that property if it's cash flowing. So that'd be my thought on that one. And then in terms of accessing the capital, yeah, if you could borrow it out at 7% or something on a second mortgage, HELOC takeout, and go lend it at 12, you can make a spread of 5%. I mean, a $100,000 difference, every $100,000 would make $5,000 a year in your pocket of differential profit. Could be worth it. It could be. For $5,000, depends if it's worth your time. Raz says, is war good for the economy? So the first part of your question is technically yes, actually. War is good for the U.S. economy. They love war. They love funding wars. That's why they're funding the Ukraine-Russian war. Or is it really U.S.-Russian war, proxy war? That's why they're funding that war, right? It's very good for the economy, unfortunately. It depends though, like, is it good for it in the short term and in the long term, right? Next question was, does it cause inflation? In some ways, yeah, because they print a shit ton of money to fund that war against Israel or Palestine or against Ukraine and Russia. And it's like, there are consequences for printing a bunch of money, right? It does drive some inflation in that aspect, but it's debatable whether the production, it should be net positive for the U.S. to produce all of these, weapons and whatnot and send it over. But just giving cash to Ukraine, like boatloads of cash, and then not tracking anything on how it's spent, how it's used, that's ridiculous. That's just corruption, disgusting, and I don't want to be a part of that. But technically, if I pay tax, I'm part of that. The money actually leaves the country, so would that not be good for the economy and not cause inflation? Yeah, I mean, the cash specifically, not good. The sending weapons and things like that can be good because the U.S. has to produce those weapons, so that creates production for the economy. Batman says, could you make a video explaining benefits of CMHC for the commercial side? So the benefits are obvious, and I've shared them several times, but one, you put very little money down, which is huge. In the commercial side, great idea. Two, your rate of interest on the commercial side is way lower. Commercial loans are brutal compared to residential. Usually 20 and 30% higher effective total interest paid. So where you might pay like 6% on the residential side, you'll pay 7.5% on the commercial side. But with CMHC, you can pay 5.5% right now, or 5%, in some cases 4.99% for large commercial residential loans on for apartment building, as an example. So it actually makes up for the cost. Plus the costs and the fees aren't near as high as a 5% down residential mortgage. So that's just part of the benefit of it, but there's other benefits too. The con side is just a lot of energy and effort to get approved for a CMHC commercial mortgage. There's a lot of hoops you got to jump through. And you can Google that for yourself, but there are lots of different programs like energy efficiency upgrades, low-income housing upgrades. You have certain things you have to fall into different programs to qualify for the CMHC preferred rates and terms in terms of loan to value. And amortization schedules too, like your normal commercial loans, like 10 or 15 years amortization, but CMHC large commercial buildings have like 45 and 50-year amortizations, which means you can pay it back over, 3 times as long, which means your principal payment, in terms of the total payment, your principal payment is much less and your total payment is much less, which is huge for cash flow. It's what's propping up the Toronto and Vancouver market right now. Why do people say list price doesn't matter when sold price is on average within a few percentage points of the listing price? List price doesn't actually matter all that much. In terms of list price doesn't necessarily mean it's what... we have a house in Burlington that we're flipping right now that I'm about to put on the market. And we were just having this discussion today, but what should we price it at? And we're going to price it at $599. It's going to be the cheapest semi in Burlington on the market by a long shot for a semi freehold property. $599. It's unbelievably cheap, and we know it's going to go in the 700s at least. And we're pricing at $599 because I want 150 showings and I want 12 offers. And so I might intentionally, if I priced it at $800, I might get a few showings, won't be as hot, someone will hum and haw, they might try to negotiate on the price. I may end up getting less, pricing my property at 800 list price versus 599. I might get more pricing the property at 599, I'll sell multiple offers for 800 something, versus pricing at 799, don't get that much interest, and someone ends up offering at 750, and they negotiate, and we have like one person. I have no competition to drive the price up. So it's all about listing strategy in terms of like list price to sale price. There are huge imbalances at times, but listing price is important. If you underprice, you may, in some cases, if I underprice it at like 749, someone might just come in at 749, and if I made a mistake pricing it not high enough, I could get in trouble. But if I price it too low, I get a multiple offer that may not get high enough. So it depends on the market. If you don't get enough, it can backfire if you don't have enough attention. So you got to price substantially low enough that you get the attention that you want. To answer your question, I gotta wrap this up here. So I'll do 2 more questions, I guess. Do you still have properties you're looking to sell? Andrew, I do. I have several cottage properties I'm looking to sell. I have a triplex in London that is the main house is a duplex up and down, main floor and upstairs. And then I have a guest house in the back. So there's like 2 full houses, but 3 units. And that one's like 699-ish. Hit me up if you want to buy that or JV that with me. I currently own it in cash, but I need to get the cash out of it. I was thinking I'll put a mortgage on it, but then I'm locked in. So if someone wants to come in and put an A-lender mortgage on it and JV it with me, I'm open to options like that. Because I would keep the property. As long as I don't have to do any management work and I just get most of the cash out of it, there'd be a play there. So I do have some property there. I have property in the Sarnia that I'm willing to sell. I have properties in the cottage market that I'm willing to sell. Yeah, hit me up. I do have a list of properties that I'm disposing of that are off market that I can be flexible and creative with. Batman says, would you mentor someone if they were able to provide you value as well? Yeah, maybe. A small portfolio of 20 units in Ontario, but I want to sell them when the market goes up and buy a bigger multi in the US. Yeah, I mean, what you're asking for is like, you're saying Texas or Florida. So what you're asking for, Batman, is like so the way it would make sense in terms of like mentoring someone for free, they would have to be bringing me enough value that it'd be worth my time investing in them. So if they became like, if I could find someone right now that could be my COO, that was like capable of everything I was capable, like me 4 years ago or 5 years ago, that is like adequately competent, could run operations, and I thought the way I did from a cost control perspective and an optimization perspective, I would happily mentor that person into being me, a better version of what I was then. I am looking for that. But in terms of mentoring someone who has no idea what they're doing and they're just like a noob with their first property, I don't find that very fulfilling. I'll do it for $900 a call, which is, decent money. But again, I'm trading time for money. So if I do more than a couple of those calls a month, I feel like I'm just like a wage slave. I'll do the odd one here and there. It feels a bit like community service. It's worth my time per hour at least. But that's my thoughts on coaching right now. Market is propped up on credit. It is so true. Consumer credit is at an all-time high per capita. Harriet says, what do you think of zero value realty? They charge flat fees instead of a percentage. People get tens of thousands of checks and cash back. There's lots of those types of discount brokerages that exist. The question is, I guess, is the savings worth the loss in price they can negotiate? So if they have a buyer or they have, if your realtor has a buyer that's willing to pay 5% more, or they can put a deal together in a way that the listing brokerage can't or doesn't by not responding quick enough, the value can be there. In general, I'm a fan of discount brokerages. I think that you should go find a full service realtor who's willing to sell at a discount. There's a lot of them out there. And as a realtor, I go and approach them and say, hey, you want to co-list? And they often do. So in terms of, getting a discount from realtors, I'm pretty good at that. In terms of Batman's question there about contacting me, it's as easy as going to Rosehart, which a whole bunch of emails, rosehartcapital@gmail.com would be a way to find me. Go on Instagram, I'm Mike Rosehart, and find me there, or Facebook. Easy to find. I'm all over there, posting all the time. Anyway, guys, it's been a great stream. I appreciate y'all. Thank you for tuning in, and we'll see you next week. Every week, around 7 o'clock to 8 o'clock-ish Eastern Standard Time. We go a little after 8. I usually start a little after 7. It's a loose timeline. But I've never missed a live stream now for how long has it been now? 5 years, 6 years of every week. So we've hundreds of these podcasts, vlog style videos you can go watch if you want to learn a ton. I share what's on my mind. I share all of it for you guys to see. And yeah, go and check those replays out. And as always, the secret to unlocking wealth through you is 3 levers and control your financial future. You got to spend less than you earn. You got to find ways to earn more money to build the gap between them. And then you got to basically invest the difference to maximize returns. So the more you can grow that difference, as that difference gets bigger, it becomes more important how you invest it. Those are the 3 levers to control your financial future. That's it. That's the secret to financial independence. Thank you for the knowledge today. No problem. Happy to help. Prediction for max time rates will remain high. I mean, we could see a scenario where it depends what they do. If they cut too early, we may have a resurgence where rates peak again in 2025, 2026. I don't think that's going to happen. I think it'll probably be a cuts into later this year. I'm hoping for cuts later this year and relief, but things are going to break soon. And I'm worried about the breaking that causes the cuts more than I am about the cuts to come. But it may be a situation where we're stuck with a couple more years of pain. That's a worst case scenario. I hope that doesn't happen. I hope they cut this year. It's a good probability that they will cut this year. I think shit's going to break soon, but remains to be seen. All right, everyone. Talk later. See you guys next week.